Welcome back, everyone. This week we're going to be talking about how it's not a real market. The focus of today's article is around this banger of a quote that'll help set the scene. Quote, I don't need to remind everybody that the quote unquote market for this sector is not a real market, right? It's not a market where you can have a large number of investors and particularly institutions participate. So the market here is very thin as far as the number of participants. It's mainly retail and it's just not efficient. We continuously see even the largest companies in this sector, $3 billion plus of market cap, sometimes are down 5% on just a couple $1,000,000 traded. So obviously, this market is far from being efficient. End quote. Now, if you're a follower of this channel, you know how I feel about the word obviously, which is more of a thought-terminating cliche and a way that people intuitively recognize something and then let it resonate without ever actually investigating what it is that's so obvious. But I digress on that point. So, let's get into this. I've come to realize that much of this talk about illiquidity and lack of institutional participation is cope and fallacy. It's meant to provide a plausible and ostensible excuse for the stock's poor performance, while simultaneously not attributing their poor performance to inept management teams who were previously and who have been perversely incentivized to recklessly grow their companies. This cope and fallacy also is meant to obfuscate any responsibility that they, the investor, had in buying ridiculously priced securities to begin with. There are numerous stocks that trade on the OTC whose performance has done quite well, and not just in this sector, but many other sectors. I'll be giving you a couple of examples in a moment. The problem is that these investors are growing desperate and they're essentially personifying markets and shaming them for not being more liquid. That's why they're not a real market. That sounds familiar to the shaming tactics used by women. You're not a real man. Talk about lowbrow shaming tactics. The underlying implication of the quote is that if things were more efficient, then these stocks would trade higher in price. Notice I said higher, not more efficiently. To most, it's a foregone conclusion that they're one and the same. However, that doesn't seem obvious to me. As far as I'm concerned, these stocks not being the center of attention allows their appraisal to run rich. Be careful what you wish for. What should a company with a 20% net income margin that's growing revenue at 5% year over year with a 3 times EV to sales multiple be priced at? That's not a rhetorical question, by the way. That's a real question. What should that be priced at? These people's reasoning for why these stocks are cheap is amusing. It's not the stock's fault for trading so poorly, it's the market's fault, right? It's not the company's fault and it's not the stock's fault, it's the market's fault. And the fallback is the government's fault. But it's not the market's fault. It's the exchange's fault. But it's not the exchange's fault. It's the government's fault. And it's the government which is the critical decider of this daisy chain. Notice how it's everyone's fault except inept management teams and investors? Talk about motivated reasoning. It seems to me that what he's complaining about in the quote of today's article is largely a function of trading on the OTC. OTC markets are less, quote, efficient than primary markets, but they're still far from inefficient. Billions of dollars trade through the OTC with small bid-ask spreads, minimal transaction costs, and oftentimes quick fills. Sounds like a first world problem if you ask me. He's right in regards to how a couple of $1,000,000 can move the needle on a $3 billion market cap company. Curaleaf fell 8% on March 11, 2024, on 532,530 shares. Yeah, 500. There's going to be a lot of numbers in the next paragraph, so I'm going to kind of make it more brief without giving every little nuance. So March 11th, Curly fell 8% on roughly 532,000 shares. Their market cap was $3.1 billion at a share price of $4.21. That means that $2.2 million, or 0.07% of the market cap, moved the stock 8% roughly. But it's not just this industry that happens to. Alphamine, which is a tin producer in the Congo, fell 7% on February 1st on 185,000 shares. Their market cap was $1.12 billion at a share price of 70 cents. That means that $129,000, or 0.01% of market cap, moved the stock 7%. Rolls-Royce, which is a company that I keep looking at and never buying, and since I've been looking at it and telling myself I should have bought it, it's up 100%, but that's how those things go. But Rolls-Royce fell 5% December 15th on 3.5 million shares. Their market cap was $32 billion at a share price of $3.83. This means that 0.04% of the market cap moved the stock 5%. On and on it goes, but these are just some examples. Rolls-Royce, a engine manufacturer, jets, this and that, cars, blah, blah, blah. Alphamine, a tin miner in the Congo of Africa. So definitely different sectors with their primary stocks traded on different exchanges. So on and on it goes. And what you see, once you keep constant your comparisons and controlled for variables, like I chronically insist, then you would recognize it's an OTC thing. These crybabies reveal their true character when you don't hear them trying to temper one another's expectations when the stock rises 10% on light volume. Nope, it's only when it falls 10% on light volume that this market isn't allegedly real. The OTC market doesn't seem any less efficient than local flea markets or farmer markets, and those are accepted to be real markets. Is the collectibles market, car market, or art market also not real markets? Is the global tin market, estimated at around $7 billion, not a real market because of its smaller dollar-denominated size and lack of participation and illiquidity? Not long ago, uranium was an $11.6 billion market. On and on it can go. Molybdenum, platinum, palladium. And by the way, yes, cannabis is also a commodity, just like platinum, palladium, molybdenum, corn, wheat. Of course, on a certain level of analysis, and then people will backfire by deflecting away from that and then viewing it on a value add in product, consumer package good level of analysis, as though, well, those end products and SKUs weren't derived from a commodity, but nonetheless. How could a market with thousands, tens of thousands, or hundreds of thousands of participants trading at least millions of dollars a day through thousands of transactions not be considered a real market? Oh, I know, because there's not instantaneous, costless, frictionless transactions due to complete liquid conditions that provide a stock price that confirms their underlying cherished beliefs. Todd Harrison said the cannabis industry's market cap is roughly $12.8 billion on the Lead Lag Report podcast, which came out earlier in 2024. Is that still too small for liquidity and efficiency purposes? And if so, what does that mean? What does that make tin stocks or other commodity stocks? And why aren't all those other people chronically complaining about how small dollar figures move stocks large amounts? They recognize it as part of the game and they move on. Like, it's never, I've never seen it even be a point of conversation. Well, once with Alphamine. I saw someone say something about how the stock fell a lot on thinly traded volume. So once, I've seen it once. And how inefficient are things? The better balance sheet and higher revenue growing companies are outperforming the worse balance sheet, slower revenue growing companies. Companies exposed to large catalysts, such as Florida Amendment 3, are outperforming companies without such catalysts. Is that because the market isn't efficient, as the quote said? Green Thumb is up roughly 100% from the bottom. What changed? Did their earnings per share increase 100%? Has regulatory change occurred since then? Is this what people are alluding to when they say that the market isn't efficient? I doubt it. I've heard people say it got too cheap to ignore. But wouldn't that suggest market efficiencies occurring to begin with? So, which is it? The funny thing, time and time again, I keep hearing people say that this industry needs more institutional money. As far as I'm concerned, the desire for institutional money is a tacit admission that retail money is dumb money, which is an interesting, as a side note, it's an interesting balance to strike when I hear media outlets say these things, and yet pretty much their entire audience is retail money. So it's interesting when someone implicitly calls you, the listener, dumb money. It's essentially saying we need the inclusion of smart money in order to dilute the impact of the dumb money which dominates this space. It is the smart money that helps offset, counterbalance, and act as the countervailing force towards the dumb money. The reason you need smart money is because the dumb money which dominates the sector is just that, dumb. The smart money's job is to dilute the dumb money's influence. The smart money is needed to neutralize the impact of the emotional, impulsive, short-sighted, innumerate, myopic, and personally incredulous retail crowd. In other words, the sector needs some adult supervision. It's actually for this reason that I'd prefer institutional money to not be involved. Quite simply, they're either short a lot of this garbage or just not participate. The funny thing is that before you know it, the same people complaining about the lack of institutional participation will then be complaining about how the evil hedge funds and institutional money is manipulating the market and is naked shorting, doing ladder attacks, or whatever else nonsense their conspiratorial minds can conjure up. To say that this sector is inefficient because institutional money isn't participating is to say that retail is inefficient, and I'd have to agree in large part with that. They're incentivized by their fleeting emotions, misinformed notions, and stuck in groupthink. And by the way, it just so happens that there are actually hundreds of millions of dollars, at least, in this sector of institutional money. So that's interesting to think about too. The epiphany I had. I was really caught up on the phrase, not a real market. And I figured out why. They committed a no true Scotsman fallacy. Person A. This market is inefficient with thin volume and minimal participants. Then person B says, but it's still a market. Transactions occur, tight bid-ask spreads, etc. And then that's when person A says, well, it's not a real market. A real market would be more efficient and well regulated. In this scenario, person A is using an arbitrary definition of what a real market is, which conveniently excludes the market in question based on subjective criteria. They're dismissing the market simply because it does not conform to their idealized notion of what a real market should be. In large part, people invest under the motto, price confirms narrative. These stocks have seen precipitous declines over the last half-decade, so in order to keep their narrative intact, they've needed to ignore price. Because remember, price confirms narrative, and they're not willing to relinquish their cherished held beliefs. This is where the claim that it's not a real market comes into play. When it's not a real market, then that means that the results, stock price, aren't real either. What's at play here is a wonky ad hominem attack. A common strategy that people use when being told something they don't like is to attack the person communicating the message. Well, they're doing the same in regards to the OTC, over-the-counter exchange. These people are ignoring the message, stock price, by attacking the one communicating the message, the market, by saying that it's not a real market. It's a common practice of people to dismiss, disqualify, discredit, discount, and marginalize the source of information rather than address the merit of the information itself. You have to remember, these people live by the motto, price confirms narrative. So just imagine how distraught they must feel to see their cherished beliefs being disconfirmed by the price action. This forces them to either stop being ideologues or to conjure up a reason as to why the price is wrong. After all, there's no way they could be wrong, LOL. This is why they attack the market structure or whatever else is needed to disqualify the price action. If you can convince yourself that it's not a real market, then by extension that means that it's not a real stock price. This allows their cherished beliefs and ego-invested narrative to stay intact. What a beautiful subversive psyop these people are playing on themselves. This is cope and fallacy at its finest. These people don't like the fact that the stocks are cheap because its cheapness is evidence of the narrative not playing out. Remember, price confirms narrative. Let me break down their bull case for you. 2018. If reform happens, then these stocks are ridiculous cheap. 2019. If reform happens, then these stocks are ridiculously cheap. 2020. If reform happens, these stocks are ridiculous cheap. Rinse and repeat for 21, 22, 23, and now to 24. I can't really blame these people for droning on and on about government stuff. What else are they supposed to talk about? Fundamentals? Well, they can't, both because they're innumerate and intellectually lethargic, but also because the fundamentals largely disconfirm their belief about how these companies are cheap. So even if they weren't innumerate, they turn a blind eye to the numbers due to it not confirming the narrative. It's heresy to even suggest that many of these stocks are trading at fair value, let alone richly. You come to realize that their investing strategy is predicated on faith. And there's no point in reasoning with someone who's practicing such behaviors. You realize their valuation targets are on a hope and dreams adjusted basis. Macro obsession. Here's a basic outline of these people's beliefs. These stock prices aren't confirming my beliefs. It's because they trade on the OTC and because institutional money isn't involved. And that's because big government is stupid and sluggish. This idea of the federal government gets smuggled into everything, always cropping up and manifesting. Everything is the patriarchy's fault. You realize that all roads lead to it being the federal government's fault. Everything gets abstracted to a higher level of analysis. It's the end-all be-all to these people. It's the beginning and the end. It's the one-liner that excuses all things. It's fundamentally a thought-terminating cliche. Not profitable? Because of the government. Profitable? Could be even more profitable if it weren't for the government. Trades on the OTC? Because of the government. Institutions aren't involved? Because government won't make it where they can get involved. Lacks scale of economy? Because of the government. Makes horrible M&A acquisitions? Because of the government. The states are doing limited licenses and companies are willing to pay a premium for artificially constrained assets. On and on and on it goes. It's a beautiful victim narrative in which their cherished industry is held hostage by the big bureaucratic fat cats. All of those reasons above are true. They are. But there's also other true reasons that are being conveniently ignored. Let's try this again. Not profitable? Management teams overpaid for overproducing assets that created too much surplus on the markets due to the fractioned industry in its nascent state, and they all played the same game of trying to flood the market with product to get that initial high price. Okay? Profitable equals management teams who are concerned with ROC, return on capital. Trades on the OTC? So what? A lot of things trade on the OTC. We've already gone over that. And some of those stocks have done quite well. Institutions aren't involved? Why would they want profitless companies with wrecked balance sheets which are growing revenue in the single digits? Lack scale of economy? If management built out reasonable square footage operations to begin with, instead of borrowing to overbuild, they would be better positioned. And a couple of companies have actually done that. Makes horrible M&A acquisitions equals management teams were perversely incentivized via their compensation structures, which were largely based on revenue and adjusted EBITDA growth. Not profitability, just revenue and adjusted EBITDA growth. I know. Asking true believers to be intellectually honest and represent reality in its fullness is like asking a bigot to stop being a bigot. It's an act of futility. In conclusion, once again, we find that cope and fallacy is at the heart of this issue. Most things people topically say are motivated by deeper beliefs. Once you find out their pattern thinking and belief systems, you can find out why they say what they say. You'll discover that oftentimes they say true-ish things in a plausible and ostensible way. Once you dig deeper, you come to discover the real motivations for the rhetorical smokescreens. Thank you for watching, and until next time.